Welcome back to Talk Tickers. This is the deep dives where we strip away the corporate fluff, ignore the PR spin, and get straight to the numbers and the narrative.
Good to be back. Let's get right into it.
Today, we're turning our attention to the pharmaceutical sector, specifically Dr. Reddy's Laboratories, ticker RDY. We are breaking down their Q3 FY26 earnings call, which just wrapped up on January 21st. And honestly, this was a wild one to watch.
Wild is a good word for it. It was a fascinating case study in how the market digests a really complex story in real time.
Let's just start with the price action because it really tells the story. Pre-market, the stock took a hit. It was down about, 1.5%?
Yeah, around 1.47%. The initial sort of knee-jerk reaction was negative.
But then throughout the day, something shifted. We saw this classic V-shaped recovery. By the closing bell, the stock wasn't just flat, it was up 4.2% to close at $13.28.
And that intraday swing is the perfect summary of the whole story here. You have this battle going on between two narratives.
Okay, what are they?
Well, you've got the old story, which is the U.S. generics business. It's commoditized. It's facing price erosion. That's why the stock dipped early.
And the news story?
The news story is the massive growth in emerging markets. And, the huge GLP-1 pipeline, that's why the stock rallied. The market decided the news story is winning.
It's the classic look-through trade. Investors decided to ignore the current pain for the future gain. So let's unpack the headline numbers that sparked all this. Revenue came in at $971 million.
Which was a solid beat. Consensus was looking for about $35 million less than that. So up 4.4% year over year, a good top-line number.
But on the bottom line, EPS for the ADR was 16 cents, exactly in line. No beat, no miss.
Right. And if you want to know why the stock dropped at first, you have to look at profitability. Gross margin was 53.6%.
Down year over year and quarter over quarter.
And that's almost entirely due to what you'd call the lenalidomide cliff.
For our listeners, that's the generic version of the cancer drug Revlimid. It's been a huge high-margin product for them, right?
Yeah. A massive cash cow. But that exclusivity period ends, competitors rush in, the price collapses, and it drags the whole company's margin profile down with it. It's predictable, but it still hurts.
And on top of that, they're sitting on a really strong cash position, a net cash surplus of $342 million.
The balance sheet is pristine.
Yeah.
Which is key. But let's stay on that margin issue because it leads us right into the core tension of this quarter, this geographic tug of war.
Right. Let's start with a headwind. North America generics. Revenue there is down 16% year over year to $338 million. That's a huge drop.
It is, and management didn't hide from it. It's the lenalidomide decline plus general price erosion. But, and this is a really important bit of nuance, they said the base business, if you strip out lenalidomide, is actually growing.
So it's like a melting ice cube sitting on top of a growing plant.
That's a perfect analogy. The headline number looks ugly, but there's strength underneath. This is the generics grind. They launched 6 new products in the U.S. this quarter, and volume is up.
But the pricing pressure just eats away all those gains.
Exactly. If this was just a U.S. generics company, you'd probably be shorting the stock, but it's not.
And that brings us to the global tailwind. The savior, really. Emerging markets were the absolute star of the show.
They really were. Revenue in that segment is up 32% year over year. I mean, that is just explosive growth.
Where's that coming from?
It's pretty broad-based. Russia, for example, was up 21% in constant currency, despite, everything going on there. But the real jewel in the crown is India.
India was up 19% year over year. That's huge for a market that's already so large for them.
And what's fascinating is the quality of that growth. This isn't just about volume. Management highlighted that 10 to 15% of their India sales now come from innovative products.
What does that mean in this context? It's not like they're discovering new molecules.
No, it means they're creating branded generics, new delivery systems, things that offer a real patient benefit. They launch these new brands, and they're seeing them gain traction, gain loyalty. It's sticky revenue.
Which is a huge valuation difference, isn't it? A company selling branded products in a high-growth market deserves a much higher multiple than one selling commodity pills in the U.S.
Precisely. That's what the market figured out between 9 a.m. and 4 p.m. The India story is sustainable, and it's big enough to offset the U.S. drag.
Okay, speaking of big stories, let's talk about the rocket fuel they're about to pour on this fire. Semaglutide, the GLP-1 opportunity. This was the most bullish part of the call.
This is the catalyst everyone was waiting for an update on. The Ozempic and Wegovy class of drugs. It's the biggest thing in pharma, maybe in a decade.
And management got very, very specific on the timeline. Let's start with India. Launch confirmed for March 21st, 2026.
And did you catch the little detail they added?
I did. The CEO, Erez Israeli, pointed out that March 21st happens to be his birthday.
You know confidence is high when you tie a blockbuster launch to your own birthday party. I mean, it's a bit of a flex, but it tells the market the supply chain is locked and loaded.
Happy birthday to me, here's a billion-dollar drug. So they're starting with the diabetes indication, the generic Ozempic, with weight loss to follow. But it's not just India, right? Canada is also huge.
Canada is fascinating. The launch window there is between February and May of this year, and they dropped a huge regulatory bombshell.
Which was?
Health Canada does not need to physically inspect their facility for this approval.
Why is that such a big deal?
Because inspections are the biggest bottleneck in pharma right now. An inspection can add 6, 9, 12 months to your timeline. Removing that risk just clears the runway for takeoff. It's a massive de-risking event.
So in Canada, they expect to be one of the few generics at launch, maybe even the only one for a short period.
And that first mover advantage is everything. You grab that market share early, and it's very, very hard for competitors to take it back.
What about pricing? Did they give any color there?
They did. They said to expect pricing at the lower end of the $20 to $70 range, so they're going for volume. And with a drug like this, the demand is basically infinite right now.
And this is a global rollout. They filed in about 80 markets. Brazil and Turkey are next, around July 2026.
So you have this steady drumbeat of catalysts. It completely changes the narrative from shrinking U.S. margins to global GLP-1 growth.
Okay, but we have to pump the brakes a little. It's not all smooth sailing. We need to talk about what we're calling the biosimilar obstacle course.
Right. This is where things get tricky. Biosimilars are incredibly difficult to manufacture and get approved. It's high reward, but very high risk.
So the pipeline updates. First, abatacept, the generic for Orencia.
That one looks to be on track. The IV formulation was filed. They expect approval late 2026. The sub-Q version is targeting an early 2028 launch. That's a $2 billion market in Europe alone, so that's good news.
But the other candidates weren't so rosy. Rituximab is delayed.
Pushed out a year, most likely. Seems to be an issue with their partner, Fresenius. It just highlights how many moving parts there are.
And denosumab got hit with a CRL, a complete response letter from the FDA, in plain English.
In plain English, it's a rejection letter. The FDA said, no, try again. It means they have to go back, generate more data, and refile. That's a delay of at least 6 months, probably more.
This all ties back to the execution risk and these FDA inspections. We got an update on those, a Form 483 update.
And it was a mixed bag, which is often the case. A Form 483 is basically the inspector's report card.
So give us the grades.
The good news, their Srikakulam facility got inspected with 0 observations. That's an A+, gold standard.
Nice.
But their FTO3 facility got 5 observations, and the Bakupali Biologics facility got a post-application action letter.
Which sounds not good.
It's friction. It means more paperwork, more fixes, more delays. It's this regulatory noise that keeps a lid on the stock. Investors are constantly worried one of these observations will escalate into a full-blown warning letter. That's the main risk to watch.
Okay, let's zoom back out. What did management guide to for the future?
R&D spend is staying pretty high. Yeah, 7 to 8% of sales. They're not cutting costs to juice short-term earnings. They're reinvesting for that post-lenalidomide world, which is what you want to see.
And gross margins are expected to settle in that 50 to 55% range.
That's the new baseline. And on SG&A expenses, which are high at around 30% of sales, they claim that spending growth will be half the rate of revenue growth.
Which implies operating leverage.
That's the bet. If revenue grows 10% and costs only grow 5%, your profit margins expand. That's the model.
All right, that covers the deep dive. Now it's time for our favorite segment. This is where we construct a trade idea that is absolutely wild, highly specific, and maybe even works.
And I have to say, this is not financial advice. We're just having a conversation. Please do your own homework.
Definitely. Welcome to the This Is Not Financial Advice segment. Today's concept, the birthday candle arbitrage.
I love it already. Go on.
So the setup is this. We have a CEO who has publicly tied the launch of his company's most important product in its biggest growth market to his own birthday, March 21st.
The human element, the ego. I like it.
We also know Canada is coming any day now, and it's de-risked from an inspection standpoint. The catalysts are all clustered in the next, say, 90 days. Meanwhile, the general U.S. generics market is just a disaster.
For everyone. Correct.
So here's the trade.
Yeah.
You go long Dr. Reddy's RDY call options. that expire in April 2026. This captures both the birthday launch and the Canada news.
Okay, that's the long side, but you're still exposed to that U.S. drag, so what's the other side of the trade?
The other side is you simultaneously short a basket of pure-play U.S. generic manufacturers, the ones who don't have a booming India business or a Semaglutide launch to save them.
Ah, I see it. You're isolating the catalyst. You're betting on the company's specific story while hedging out these sector-wide risks.
Exactly. You're betting on the birthday effect. You're betting that a CEO will move heaven and earth to make sure he gets his birthday present. It's a bet on corporate pride.
It's outrageous, but the logic is sound. If the CEO wants that win on his birthday, he's going to make sure everything is lined up perfectly.
That's the birthday candle arbitrage.
Of course, the risk is that the FDA shows up at that Bacupoli facility next week with a bad report card.
And the birthday party gets canceled. That's the risk. But that's why we play the game.
Indeed.
So to recap, Dr. Reddy's beats on revenue, meets on earnings. The U.S. business is a tough grind, but emerging markets are absolutely on fire.
The transition is messy, but it's happening. They're moving from a simple generics company to a global, more innovative one. Q3 showed that the strategy is working, and the semaglutide launch is the big, immediate catalyst to watch.
And the market voted with its wallet, turning that pre-market dip into a 4% gain. Now we just have to wait and see if the CEO gets his birthday wish.
You'll be watching the calendar.
As always, thank you for listening to Talk Tickers. Do your own research, check the charts, and we will catch you on the next earnings call. Talk Ticker signing off.